Debt mutual funds are like baskets of bonds and similar investments. They pool money from many investors. This money is used to buy a variety of debt instruments. These instruments can include government bonds, corporate bonds, and treasury bills. Debt funds focus on preserving your capital. They aim to generate regular income. This income comes from the interest payments on the debt securities held within the fund. Think of it like lending money to a company or the government. You receive interest payments for lending your money. Debt funds collect these interest payments and distribute them to you. Debt mutual funds are ideal for cautious investors. These investors prioritize the safety of their money. They also desire a steady stream of income. These funds are less volatile than equity funds, making them suitable for risk-averse investors. If you are looking for regular income, consider debt funds. They are a good option for short-term financial goals. You can use them for parking emergency funds or saving for a down payment. Remember, though, that while debt funds offer lower risk than equity funds, they are not risk-free. It is important to understand the different types of debt funds and their risk profiles. Debt funds and fixed deposits, or FDs, both fall under fixed income investments. They differ in their risk and return profiles. FDs offer a fixed rate of return, while returns from debt funds can fluctuate based on market conditions. However, debt funds offer the potential for higher returns over the long term. They also provide greater liquidity compared to FDs. You can withdraw your money from most debt funds at any time. FDs, on the other hand, have a fixed tenure. Premature withdrawal from FDs can result in penalties. Choose debt funds for potentially higher returns and greater flexibility. Section 4. How returns are generated. Debt funds generate returns in two ways. First, they receive interest payments on the debt securities they hold. This interest income is distributed to investors as dividends. Second, the prices of bonds and other debt securities fluctuate in the market. When interest rates rise, bond prices generally fall, and vice versa. If a debt fund manager sells bonds at a price higher than their purchase price, it results in capital gains for the fund. These gains are passed on to investors. It is important to note that while debt funds aim to provide regular income, their returns are not guaranteed. The actual returns may vary depending on market conditions and the performance of the underlying securities. Section 5. Safety and support for investors. When investing in debt mutual funds, ensure you invest through a SEBI-registered fund house. SEBI, or the Securities and Exchange Board of India, regulates the securities market and protects investor interests. Before investing, you must complete a KYC, or Know Your Customer process. This process helps in preventing financial fraud and ensures the security of your investments. If you have any concerns or grievances, reach out to the investor support team of the fund house you have invested with. SEBI also provides a platform for investors to lodge complaints against any registered entity. Remember, investing involves risks, and it's crucial to understand them before making any investment decisions. Always consult with a financial advisor to determine the most suitable investment strategy for your financial goals and risk tolerance.